Hey, welcome back fellow Baba bag holders. Just when we thought that the end is near and we are near the end of the tunnel, and Chairman Xi decided to start easing the economy by cutting the loan prime rate, we were essentially hit by a truck again with all the different corruption scandals and basically an overall weak market. I think it will be extremely timely, especially in an extremely volatile market, to revisit our price target for our high conviction picks and more importantly our entire portfolio, to reassure ourselves that we are definitely in an extremely crazy opportunity rather than a story with zero fundamentals. So this video is sponsored by StockCard and we'll talk more about them later. So 5 months ago, I have created an Alibaba DCF video outlining what were my underlying assumptions and my expected growth rates for Alibaba in the coming decade or so, projecting all the way until 2030. 5 months later, I'm back with an updated model with new and updated quote-unquote guidance and assumptions to try to show you what exactly is going on in my mind today. And as always, I will leave the link to this updated model in the description box below. So please, feel free to download it and play around with your own assumptions. So long story short, it's still extremely good news, at least based on my own outlook. So on top of a simple DCF, I have also included an additional valuation method to cross-check the different numbers that we arrive, so stay tuned to the end of that. So just to square away some of the potential questions first, this will not be a step-by-step tutorial video to talk about what does each entry mean or to talk about what this growth rate mean and how should you get the different numbers. If you are more interested in those different explanations, in the entire DCF model specifically, please go ahead and watch the older video instead because I explain a lot more there. More importantly, just a huge caveat, and by huge, I mean really huge, all the different numbers presented in this model are purely based on my own projections and I essentially pulled it out from my ass. And as you all know, I'm an extremely huge Alibaba bull. So just take everything I say with a pinch of salt. Also, don't forget to smash the like button too, because that will help you boost your social credit score. Now, as Alibaba's financial year actually ends on the March of every single year, where the results will probably be released in May subsequently, you can look forward to a new updated projection in the middle of this year when they actually conclude the financial year with the official free cash flow data. So this 2022 data is particularly important because we can then assess the impact of the crackdown on big tech since 2021, because essentially this fiscal year is at the peak of the crackdown. So to start off a DCF, you will need to have access to the free cash flow data, and it could easily be retrieved from databases or their financial statement. So let's work with the same assumption that Alibaba will be generating around at least 30 to 31 billion in free cash flow from its prior years. So in comparison to the previous DCF video that I created, I've actually adjusted down my growth assumptions and my free cash flow multiple, and I'll be explaining a little bit on later. First, let's look at how Alibaba's free cash flow grew in the last 5 years. As you can observe, it doesn't take a genius to figure out how monstrous the growth was since 2016. They did $37 billion in renminbi in 2016, and now they have $186 billion renminbi in 2021. They essentially 5x their free cash flow growth in 5 years, but the stock price appreciated by 40% from 2017 until today. What a phenomenon. Anyway, as you can see, the free cash flow growth has been rather choppy over the years, especially during 2019, when the growth suddenly plummeted to the high single digits. In order to understand the context behind this specific growth and this anomaly, let me try to superimpose two graphs to let you have a better understanding of what happened and what transpired then. First, the 2019 number actually represents the year between March 2018 to March 2019 because, like I said, Alibaba's financial year ends on the March of every single year. So the first graph we should look at is the price patterns of Alibaba's stock during that period. So they essentially peaked at around June of 2018 and plummeted by a solid 36% in December of 2018. Sounds familiar, right? But that said, we essentially plummeted more than twice from then. So some of you might be asking why. The second graph that you should look at is the regulatory tightening cycle in China. So like market cycles, the Chinese government also operates and interrupts the economy in cycles to essentially, quote-unquote, get everybody back on the same page. As you can see, it perfectly coincides with the 2018 episode of regulatory tightening, which explains the travesty in Alibaba's growth. However, you can also see that it doesn't seem to faze Alibaba after that 2018 episode. So if history was to provide us with any sort of guidance, the current unprecedented regulatory tightening explains why Alibaba was down more than 60% from its all-time highs. Of course, I'm not insinuating that Alibaba will do the same again. You can be your own judge. So, the most important questions that we have to ask ourselves is, what will Alibaba's free cash flow growth look like in the coming 5 to 10 years? Same thing, I have 3 scenarios and I have adjusted my numbers downwards since the last DCF video to project a much more conservative case, and in case people accuse me of blowing numbers out of proportion to make a better case for Alibaba. So in the DCF, the 3 critical elements are the growth rate, the discount rate, and the terminal multiple. Disclaimer again, all the numbers you see online are all put out from the analysts as. But of course, they try to substantiate it with their own analysis and observations. So I will also attempt to do the same. First, looking at historical growth, my base case of growing at 12.5% in the first 5 years and subsequently 7.5% in the next 5 years might seem a little too conservative because Alibaba was essentially posing monstrous results in the past. That said, Alibaba can be considered a fairly matured company if you were to compare it to its industry peers. So one thing, however, that I love about Alibaba is that there are strong circular tailwinds for the entire e-commerce industry in China by and large. So even if the management sucks, of course I have a disclaimer here, which I probably don't think they are, they should technically grow alongside the industry growth rate. And the Chinese e-commerce market is expected to register a CAGR, which is compounded annual growth rate of around 11.6% between 2021 and 2025. Hence, the 12.5% expected growth is on top of the circular tailwind with the addition of their cloud and international growth engines. Unless you truly believe that Alibaba is just a lame duck, currently sitting on their ass, waiting to get disrupted by their competitors, I don't see why they are unable to reach all these different growth levels that I've projected in my base case. Next, the discount rate that I use is to fix it at 12%. And if you just do a very simple Google search on the weighted average cost of capital of Alibaba, which is WACC for short, they actually do post a result of around 6 to 8%. Hence, putting a 12% discount rate is already extremely conservative. Therefore, I will show you guys the output for both scenarios where I will use 10 and 12% discount rates accordingly. Now, we have to also agree a terminal multiple for Alibaba in year 10. So if you were to study the market cap to free cash flow multiple of both Alibaba and Amazon, I think suggesting a terminal multiple of 12 is not exactly exaggerating. Let's not forget, the multiple on Alibaba the last 1 year was just hysterical because of the market sentiments surrounding the company, and more importantly, nobody is interested in buying any companies that are in China. Just in September of 2020, they had an average multiple of 44. And if you were to look at Amazon, the comparison is essentially non-existent. So with a 12% discounting rate, the price target for Alibaba today is at $226. And even if you slap a 15% China discount, it should minimally be trading at around $192 today. Now, if you were to use a 10% discounting rate instead, which I think would be a much more fairer comparison for Alibaba's business, the price target for today is $261. And with the China discount, it's $221. Now you know why I keep adding to this cancerous stock, even though it's essentially bleeding my entire portfolio and net worth out. Now, some of you might not agree with some of the assumptions in my DCF model, and it is perfectly fine and it's perfectly okay. I won't take any offense, because this is a free roll. Nobody is forcing you to buy this stock anyway. So if I were to use another valuation technique in my attempt to try to convince you that it's extremely undervalued, it's called sum of the parts, which is SOTP for short. And instead, I will only value the e-commerce business today, completely ignoring cloud computing and financials. The numbers still remain ridiculous. looking at China's core commerce EBITDA for financial year 2021, and if I were to slap on an EV to EBITDA, which is enterprise value to EBITDA multiple, of 12 for the bear case and 15 for the base case, adding on the cash and offsetting the debt Alibaba has today, I arrive at a $174 price target and a $212 price target just for the pure commerce vertical of Alibaba's business today. So AliCloud and Ant Financials are essentially free gifts to the investors of Alibaba, coupled with a margin of safety for its core commerce business. So for those of you who have questions on how I arrive at the EV to EBITDA multiple, I'll be attaching the EV to EBITDA multiple of Alibaba as a whole company over the last 30 quarters. And you'll be your own judge of whether the 12 and 15 multiple is too much of an ask. That said, I can only request you to touch your heart when you input the numbers. Now, some of you might be interested in my 2030 price target, which is 9 years from now. To sum it all up, I've included a more granular breakdown of the targets for Alibaba share price all the way until 2030. And I arrive at a price target of around $620 by 2030. So some of you might proclaim that, oh, I'm overly pessimistic, or sometimes even overly optimistic. Whatever it is, investing itself is a form of art and science in the first place. Now that we have a price target in mind, I'm introducing today's sponsor, StockCard. So StockCard essentially wishes to make research simpler, lowering the barriers to entry for investing. Not everyone is as geeky and nerdy as me that don't mind spending time crunching numbers and devoting your whole life to the stock market. So some of you might just want to research stocks easily and intuitively and have screeners at your fingertips. So if I were to search up Alibaba now, the dashboard essentially prompts up a few key pillars pertinent to the company specifically in an extremely digestible way to understand, even for the layman. So as you can see, Alibaba has high growth potential, strong operations, and is deemed to be undervalued. But it seems like we have rather pessimistic investors today, and it has historically underperformed the entire market by and large. So the most interesting thing is, if you were to go under the individual categories to understand Alibaba's growth potential, StockCard actually provides you with the potential growth engines and the potential research points as a starting point for you to develop your own thesis and to do your own due diligence into understanding the entire company by and large to build a solid foundational understanding. Currently, there are 29 buy ratings and 6 hold ratings from analysts, and the average target is around $193. Of course, for people who have held from the start, you know that the price targets from different analysts has always been on a downtrend as the stock continues crashing. Analyst price targets by and large are no longer an effective barometer to take references from because most of them essentially just try to react to the current market sentiments rather than a real evaluation on the business itself. So you can also get updates and reminders on new developments surrounding the company on your watch list on StockCard. So if you're interested in signing up, links will be in the description box and you can get a 10% discount for the VIP version if you have to use my link. Nothing on the internet is financial advice, by the way. I also don't think anyone come online to give you rubbish financial advice or stock picks because most of them wants to look smart in hindsight for calling things out before they really happen. So I urge you to really have a solid foundational understanding of what you are looking into before even starting a position, whether is it in Alibaba or not. So to end off this video, I would just like to read off a Reddit comment that I came across quite some time ago. So the question isn't whether Baba is undervalued or not. Even my dog knows that Baba is massively undervalued at current prices. And my dog is dumb as a rock. So the real question is if Uncle C is done with Chinese big tech or not. If I knew the answer to that, then I would liquidate everything that I have and put my life savings on Baba Leaps. Truth be told, nobody have an answer to that. People who claim otherwise are just screwing with you, whether they are claiming that it's the end of Chinese big tech or whether a rebound is coming soon. I think the biggest question from me to you would be, why do you think this crackdown happened and who was it for? Was it really plagued with political agendas where big tech is so scary and is threatening the legitimacy of the Chinese Communist Party? I think that will give you an answer to whether there will be a turnaround for the company or Chinese equities by and large. That said, this thing has dragged on for pretty long and there seems to be no expiry date to when this will come to an end. So I do caution investors who intend to use options to think again. So with that, I'll see you in the next video, but more importantly, I'll see you on the moon. Goodbye!